So, Chandra, can you explain FHA financing?
Yes, yes. There are two major types of government funding, and one of them would be FHA, is a mortgage that is insured by the Federal Housing Administration. And typically the down payment is 3.5%, and a minimum credit score allowed is 580. And again, as to Reggie's point, right now in this new quarantine COVID period, a lot of lenders are upping that credit score now. Some are now anywhere from 620 to 640 is the minimum for being able to be approved for this type of mortgage. This mortgage also has to, properties have to actually meet a FHA guideline. And so that means that the roof has to be within a 3 to 5 year life expectancy. The mechanicals, the plumbing, and the electrical must be in good working condition. So there are some things that the actual property has to inspect and have these certain types of requirements here for that property to be able to be eligible for the FHA mortgage.
All right, and then explain the VA financing.
Okay. VA financing is another obviously government funded loan, and it's for properties, for any property actually that would qualify. And it's really one that's guaranteed by the federal government, by the Department of Veterans Affairs, and it's eligible to all veterans are able to purchase properties with no down payment. And so really it doesn't have any type of down payment and or minimum credit score. They base those criteria off of whatever lender that you use. So VA really is just saying, we are guaranteeing this loan. You need to go to an actual lender to get a pre-approved for this type of loan, and they will give you the criteria that is necessary in order to qualify for that loan.
And keep in mind, because a lot of people get confused that we get callers or buyers that call and say, hey, I have my VA certificate of eligibility, but that doesn't necessarily mean you qualify for a loan, because there are still income and credit requirements, and each lender has to comply with VA guidelines. So your certificate of eligibility just states that you qualify for the program. The amount of the loan you qualify for is based on your income and expenses. So VA is a little different. They don't have a strict income to debt ratio. It has more to do with income and size of household. And there are ways where you can have two VA loans. And if you're interested in that, we can discuss that offline as well. You can just email us and we'll explain that. Due to time, we have to explain that later. Now, another option is, so when you're buying homes, FHA or VA financing, I get tons of calls for people calling me on bank foreclosures. And the thing with VA and FHA, the home has to meet certain requirements. So if the furnace doesn't work, or if it doesn't have a furnace, there's no plumbing, the roof is bad, VA and FHA will not finance those homes in that condition. Those repairs have to be done prior to closing. Now, some FHA lenders will allow an escrow to be set aside for repairs under $5,000. So for example, let's say it's December 23rd and the roof is covered with snow. There's no way you can replace that roof during the winter months. Some lenders will allow you to hold a certain amount. So if the roof cost is $7,000 to replace, then the seller, if the seller is paying for the roof, the seller may have to set aside with the title company under the lender's guidelines, say $10,000, for example. And once the weather allows, that contractor can go out and repair the roof, replace the roof, and then the funds would get paid to the contractor and the balance would get reimbursed to the seller. That's if the seller's paying for it. Now, another program FHA allows is the FHA 203K. This is for owner-occupant purchasers. And this is how people are buying HUD homes and bank foreclosures in as-is condition. If you have a notepad, just simply write this down. It's very simple. Let's say you find a home and it's on the market for $100,000 and the seller's willing to sell it for $100,000. But you know the home is worth $150,000. but it currently does not meet FHA or VA guidelines because it needs $10,000 in repairs. A FHA 203K loan will allow you to take out a mortgage for the entire $110,000. So you have your $100,000 purchase price, $10,000 cost for repairs, but the home is worth $150,000. So you can do all the FHA required repairs plus any upgrades and things that you may want. Say you want to put in new carpet, as long as the total purchase amount does not exceed the after repaired value. So if that home appraises for $150,000, that's the maximum that you can take out a mortgage for on that property. So let's say you want to put $20,000 into the home and you bought it for $100,000, and you just want to gut the kitchen and remodel that property. You can do that as long as you don't exceed the appraised value. But keep in mind, you have to qualify for $150,000 or $120,000 or whatever that mortgage amount is as well. So that's a good way for if you're buying a home and you want to buy a home as is and you want to negotiate a lower price with the seller. As long as the seller is willing to accept those terms, 203K loans can take probably an additional 2 weeks to close. So that goes into that price and terms, because if another buyer comes along that's paying cash, same price, and they can close in 2 weeks, a seller may not want to wait around for your offer, for your deal to close. And then, so let's look at FHA income to debt ratios. This is very important. So FHA and most lenders have similar income to debt ratios, but the percentages may be different. So FHA has a 41% and a 29% formula they use. So if you look at the bottom here, and we use an example of someone earning $3,500 a month, you multiply that times 41%, that gives you $1,435. But then you have to deduct your monthly expenses such as car notes, monthly credit card statements, any revolving debt that you have. Now, if your student loans are in deferment, some lenders will allow you to not calculate that in this formula. So let's say your total expenses and you're left over with $985. That's what you're going to qualify for as a house note. Now, the 29% formula is still applied, and that's without the expenses, and that comes up to $1,015. What the lender is going to do is they're going to take the lesser of the two in this formula, and that's what you're going to qualify for. So someone with maybe making the same amount of money with a $500 car note is going to qualify for less. So it's different if you buy the car after the fact, because car financing is completely different than when you buy a home. And actually, being a homeowner helps you buy a car in some cases, because they ask you on the application, are you renting or do you own, and how long have you been there? Because they know the likelihood that you're going to move in the next year or so, and they can't find you, that you're going to probably still be in that home. But for example, in this situation, that's probably going to buy you a $160,000 to $170,000 home. So in most cases, you're not renting a $170,000 home for $900 a month. And it just depends on your taxes and insurance, but that's approximately where you would be at if you were buying a home, if you could afford to pay that under this formula. So conventional financing is just a standard loan. Each individual bank, credit union, or mortgage company, they can determine what programs they want under conventional loans. These are just loans that are not backed by any government entity such as FHA or VA. And then we have land contracts. So here's the thing. I've seen a lot of people get scammed with land contracts, mostly because people don't understand what a land contract is, and they don't understand the proper way of doing a land contract. You should close your land contract with the title company. Now, you can do it without a title company, but I would still recommend doing a title search. The reason I say close at a title company, whether it's a quitclaim deed, cash deal or land contract is because there's a verification process to make sure the seller is who they are. But more importantly, with a land contract closing at a title company, they're going to have the seller sign a deed and hold it in escrow. Because what happens is you pay off the land contract, let's say the seller passes or the seller disappears and you can't find that seller. Now you have to go to court and sue for quiet title to get free and clear ownership to that property. Now, if it's held in escrow, then, and I mean the deed is held in escrow with the title company, you only have to show them proof that it was paid in full. They're going to record that deed because it's already drafted and signed by the seller, and then you have free and clear ownership. Now, when you do a land contract, you must record it with the county, just like you would a deed. The difference between your mortgage and a land contract is with a mortgage, you're going to get the actual warranty deed, and your lender has a lien on the property in the form of that mortgage note. With a land contract, the land contract is recorded. It now shows you as the owner of the property, but the seller still has an interest. Their interest is just limited to their balance. So in theory, it's the exact same thing, but instead of a mortgage company, you're just paying payments directly to the seller. The advantage of a land contract is you can negotiate the down payment with the seller. You really can't negotiate too much with the banks nowadays, how much you want to put down. You can negotiate the interest rate. You can negotiate the terms. Do you want a 5-year? Do you want a 30-year? Whatever you negotiate. Now, the maximum interest rate for a land contract that can be charged in Michigan is 11%. Not likely to happen in the mortgage industry as of now, but there was a time when mortgage rates were 18% and people were buying on land contract because the most they would have to pay was 11%. So keep that in mind. Land contracts should be recorded. There's a proper way to do it, but most people do it just hand in hand. You know, I know somebody selling a house and they end up getting screwed or they fall victim to a scam or something like that. So if you need help with land contracts, just contact me. So let's talk about other financing programs. Chandra, you want to cover MSHDA?
Yes, MSHDA is one of Michigan's down payment assistance program. MSHDA actually stands for the Michigan State Housing Development Authority, and really it's the down payment assistance portion to this. And so it can be used with other loan types like conventional FHA or VA. MSHDA loan, the MSHDA loan itself is where the buyer contributes 1% down. And right now, the actual down payment assistance that they're allowing is $75,000. There are times when that is upped and it goes up to $15,000 that they're allowed in down payment assistance. And so they do have to qualify for MSHDA. MSHDA has separate criteria besides what a conventional or FHA criteria is. So it's a separate qualification. So your lender will qualify you with FHA or VA, and then they'll also qualify you with MSHDA. And so there are some certain standards. So say like if you are, if you're not married, but someone that's an adult over 18 is living in your house, they may actually have to be on the loan as well, because if they're working, they're over 18, MSHDA considers them as somebody that can contribute to the household expenses here. And so those are the different types of nuances that the MSHDA program has, but it is a good down payment assistance program. $75,000 will need to be repaid, but it doesn't get repaid until you actually
$7,500.
I'm sorry, $7,500 doesn't get
a whole different program.
doesn't get repaid until you sell
Right.
the home.